China's economy grew at 7.6% in 2013. While that's only 0.1% below 2012's growth, potential storm clouds are brewing. Late last year, the country's banking system faced a cash crunch, and the country is carrying large amounts of debt. Joining us now to tell us what a slowdown could mean for the global economy, in Washington, D.C., Nicholas Lardy. He's Senior Fellow at the Peterson Institute for International Economics. And with us here in studio, Gregory Chin, Professor in the Department of Political Science and Faculty of Graduate Studies at York University. And Dr. Lardy, it's great to have you on the line from Washington. And Greg, nice to see you again. Happy New Year to both of you.
Thank you, Steve.
Let me start by reading something that a guy named Scott Barlow, who's a 20-year vet of Canadian investment banks, now writing for Canada's national newspaper, the Globe and Mail, wrote quite recently. He said, China was the world's fastest growing large economy in 2013 and one of its worst performing stock markets. Not only have China's wealthy been avoiding the country's equity market, they've been desperately trying to move their wealth entirely out of the country. Why would the best informed segment of China's population look to move money overseas when local economic growth is widely expected to continue at 3 times the rate of the United States? I suspect the reason that China's moneyed elite isn't pouring their wealth into China's stocks is because they hear the loud ticking of the country's debt bomb. That's Scott Barlow's view, and I want to get your view now. Nicholas Lardy, what's your view of the general state of the health of China's economy today?
I think it is reasonably healthy. I think we've seen a slowdown from the long-term 10% growth rate down to the 7 to 8% range. I think China can sustain that. I think the risk of going substantially lower for a prolonged period of time is quite small.
Greg Chin?
I have to agree with Dr. Lardy. I think there are things that we've been worried about, growing debt, shadow banking, potential real estate bubble in China. But overall, I think things seem to have stabilized now. And the latest World Bank report, global report assessment, they've put China this year to be at growing around somewhere around 7.7%.
Nicholas Lardy, help us understand, for those of us who live in the West and have been accustomed to seeing our national and provincial growth rates at anemic levels for many years, help us understand how people can be concerned about an economy that is growing north of 7% annually.
Well, I think a lot of people felt that 9–10% was going to last forever, and the transition to the 7 to 8% range has been somewhat disconcerting. I don't think it's something to be alarmed about. I think China has good prospects for growing much more rapidly than developed economies for quite a long period of time. They're still in what we would call the convergence phase. It's a very big economy, but in per capita terms, we're still looking at something way, way less than advanced economies. So there is still potential for convergence towards the per capita standards of development in advanced economies.
Just add a little flesh to that bone, if you would. When you say a convergence stage, what does that term actually mean?
Well, if you go back 30 years, China was, their levels of per capita output were about 2 to 5% of the U.S. level. Today, they're about 25 or 30%. I don't have the exact numbers at my fingertip, but they have closed a substantial portion of the gap in terms of the level of per capita economic development. That's by virtue of the fact that they've been growing at 10% for almost 35 years, compared to the, let's say, 2.5–3% in a country like Canada or the United States. But they haven't exhausted that convergence. They're still substantially behind the levels of per capita development in advanced economies. And I think there's potential to converge further towards those levels over the next decade or two.
Greg Chin, how great a risk is it? We know they're holding a great deal of debt of many countries, particularly the United States. How big a risk is it that that debt is going to catch up to China and there's going to be an economic collapse as a result of it?
Well, I guess the question about a so-called hard landing linked to rising debt levels in China. I think China's developed a number of tools and insulation measures, and they have a number of the central bank and the Chinese authorities have a number of tools to deal with the current situation to try to maintain stability. And I think one of them is a strong fiscal capacity of the Chinese state, the ability of the Chinese state to it has a large budget to work with. And in that way, I think we've been able to insulate China to some degree from even some of the troubling trends that we have seen emerging in China, such as rising debt level. And
what's it at now?
Well, it's not clear. Some statistics are something like, I think about 30% of GDP or something like that. You'd have to go to Nicholas Lardy on the exact figure. I think Nick would be closer on that, but would be clear on that. But I think the thing is that China, I think, has the tools to basically manage the situation.
Nicholas, you got a number for us on that?
Well, the central government debt is about 30% of GDP, and then there's a substantial amount of additional debt that's been issued by provincial and local governments, subnational governments. That brings the total up into the range of about 45 to 50%. A couple of things to be said about that. The level itself is not alarmingly high. What is somewhat alarming is that it has grown extremely rapidly over the last 3 to 4 years. So they've more than doubled this debt in a 3 or 4 year period. So that it's not the level yet that's alarming, but it's the trajectory. And if the trajectory were sustained, they would get into levels that would be much more problematic. A couple of other things to consider. In many cases, in other countries that have had credit booms and debt buildups, there's been a substantial amount of foreign currency exposure, which leads to what economists call a mismatch. You owe a lot of money in foreign currency, typically in dollars, but your domestic economy runs on, let's say, the RMB or the real or some other currency. And if your currency would depreciate vis-a-vis the dollar, then the burden of repaying that dollar-denominated debt could become a killer. And that's what we saw in the Asian financial crisis in countries like Thailand. China has virtually no dollar-denominated debt, so it doesn't have this currency mismatch problem. All the debt is in domestic currency, in their own currency. In fact, you know, they're a net lender to the rest of the world. They have very large foreign currency reserves, just announced today, $3.8 billion at the end of last year, up another couple hundred billion, 3.8 trillion US dollars. So they have very, very substantial reserves. And a final factor to consider when you look at debt, economists always look at debt, it's just like a household. You have high level of debt, can you pay the interest, can you amortize your loans? Right. And you know, for households and for countries, that's a function of the savings rate. If you're spending 100% of your income on consumption, you don't have much left to pay off your credit card or other debts. China is, as a country, is saving half of what it produces. So it has enormous resources to pay down debt. So it could sustain a much higher level of debt than most other emerging markets, if it chose to do so. I'm not saying that would be a good strategy. All I'm saying is when we look at the level of debt, we have to look at what's the level of savings that's available to finance the debt.
Well, I heard this analogy, Greg, the other day, and you can tell me if it's crazy, but I do remember once upon a time there was a Texas energy company called Enron, which everybody thought was a wonderful darling and was making, you know, money hand over fist, and then everybody realized one day it was a house of cards and it came tumbling down. Are there any analogies to China here with that? Well,
I think, yeah, it's really, I think, for example, in the real estate sector, and overinvestment in the real estate sector, commercial development, whether there's a bubble emerging there. I think the central bank and other financial authorities in China are now trying to put in place measures to try to deal with, to curb some of the speculation and the overinvestment in those sectors, as well as there's questions about overinvestment in the manufacturing and industry. I'm less concerned about overinvestment in the area of infrastructure. I think China can continue to develop. China has a lot of infrastructure needs, especially if you look into social infrastructure. But I think it's whether they're able to curb some of the overinvestment in those other areas that I've just mentioned. I think that's where there's some potential for some danger. The other thing is, but perhaps this is jumping too far ahead in where you want to go, is how quickly they liberalize, how quickly they open up and allow for free flow of capital flows. I think there's questions of sequencing and timing on that as well.
Well, you've pointed to what some of your concerns are as they relate to 2014 and looking ahead. Nicholas, maybe I can get you to do the same thing. As relatively bullish as you are on China looking forward, What would you point to as your greatest concern, economically speaking, as you look at 2014?
Well, I agree with Greg that the government needs to bring down the rate of investment, and I think they're pretty determined to do that, and the main mechanism is going to be to raise interest rates. You mentioned in your opening piece, Steve, that the central bank has been pushing interest rates up, and I think we'll see more of that. And a lot of corporates are very highly leveraged, that is, they have a lot of debt. The cost of carrying that debt will rise as interest rates move up. And so a number of firms, particularly state-owned firms that have low return on assets, will be under very substantial pressure. And that will be a risky transition. They know they need to bring down the share of resources that's devoted to investment, but getting from where they are to where they need to be is a very risky course. Some firms may have to sell off some of their assets. A few of them may even go bankrupt. And so a lot of concerns about social stability will be raised. It'll be raised by those who are trying to protect the weaker companies in the economy.
Let me read for both of you now an excerpt that ran on Forbes.com towards the end of last year. This is by a woman named Junheng Li, who runs an equity research firm focusing on Chinese companies, and she's also the author of a book called Tiger Woman on Wall Street. And she has a bit of a checklist here. Let's go through this. On November 15th, the Chinese Communist Party released, quote, a decision on major issues concerning comprehensive and far-reaching reforms, a document detailing the party's reform plan. The 11 key features of the plan are a new role for the government and market-driven resource allocation, state-owned enterprise reform, fiscal reform, integrated rural-urban development, land reform being the key, democratic consultation, judiciary reform, anti-corruption, social media and internet management, a new state security committee, environmental protection, assigning custodian rights for natural resources to responsible parties being the key, and a new small leading group to coordinate reforms. Okay, that's a pretty exhaustive checklist, Greg. Do they sound like the right things on the list as far as you're concerned?
Oh, you're right, Steve. It's a very broad checklist, isn't it? And I think in that way, for those who are kind of history scholars of Chinese economic history and recent economic policy, this third plenum hasn't just stuck to the economic issues. It's tried to identify some key areas of priority where they want to reform on as far as the Chinese economy, but they've also...
Take a second and tell everybody what the third plenum is.
Right, so that's one of the key meetings following up on the leadership change in the Chinese Communist Party, and it's a key meeting where the Chinese Communist Party sets out the priorities and basically the plan and for at least 5, if not almost 10 years. I think it's actually they're setting out the plan for the next decade of China's economic and socioeconomic and political reforms. Right? So in that way, it's a key meeting that lays out the agenda and priorities of the Chinese authorities.
Nicholas Lardy, of all of those 11 things on the list, which would you say is the most urgent that they attack?
Well, I think the most urgent is the phrase that they said that was mentioned in the checklist, that the market will become the decisive force in the allocation of resources. That is, I think, the single most important breakthrough compared to previous reform documents. In previous reform documents, they've talked about how the market could play a supplementary role to the plan, and it was an important part. But they've never said that the market would play a decisive role in the allocation of resources. So the role of the market is now above the role of government bureaucrats and the planning process. That has very widespread implications throughout the economy, and if it's carried through in a systematic way, I think will really mean that China's taking the last step towards becoming a much, much more market-oriented economy.
Well, they're not, I mean, if they mean it, Greg, they're not really a communist country anymore then, are they? If they mean it.
Right. Well, I think that's part of China being a so-called communist country is whether the Communist Party is still in charge of things, right, in China. And I think they're probably in the process of rethinking what all this means. I know that in China there's debate for those who are responsible for state doctrine in China to to think through what does it mean for China to continue forward with its building socialism with Chinese characteristics.
But if they give primacy to the markets over the party bureaucrats, that's a significant step.
Yeah, I think that, well, I think in that way, they're going to think very hard about how do they maintain the public good, even while they move towards a more marketized and liberalized economy. And that's where I think some of the other realms, where what you can see is, for example, they also talk about political rights and human rights, enshrining and protecting, increasing the independence of the judiciary.
They don't mean any of it, though.
Well, I actually think they do mean it. At the same time, they still want to ensure that the Communist Party is still the ultimate ruling force in China. And they're also talking about increasing the role of non-party actors in the overall policy process in China. So I think they do mean it, but at the same time, they want the Chinese Communist Party to still be in charge.
Is that called having your cake and eating it too? Something like that?
It's definitely a complicated reform process.
Right.
Yeah.
Nicholas Lardy, how optimistic are you that any of the things that are on that checklist will actually come to fruition in a way that you think you'd like to see?
Well, some of the things on the checklist have been on the agenda in the past, and implementing the necessary reforms has been blocked by vested interests. I think the key question many people are raising today is, what will the pace be on this agenda? Who's going to be in favor of it? Who's going to drag their feet, and so forth? So I think that's the key question. I happen to think that Xi Jinping, the top political leader in China, does believe that the current economic model will not work for the 10 years more. That's his time in office if all goes well. And he's put his prestige behind and his power behind moving ahead on this reform agenda. He was very dominant at this recent meeting. He's taken charge of a leading group on comprehensive economic reform, so I think the chances of implementation are going up.
Greg, what do you think admittedly he's only been in power for about a year, I guess.
Right.
What's the early verdict on Xi Jinping and how he's doing as the new Chinese leader?
Well, I think building off of what Nick said, I think Xi Jinping, we're getting a fairly clear indication that he's a fairly bold leader. He's not afraid to take decisions. In that way, he's quite different than the previous leaders, Hu Jintao and Wen Jiabao, not as far as taking decisions, but a willingness to kind of stick his head up and actually lay out a fairly confident and bold reform plan. And he's also, I think, been showing that he's been willing to actually take some of the difficult measures to implement, to push through. As Nick mentioned, dealing with vested interests. I think this is where, in scaling back, for example, the state enterprise sector and increasing the role of the private sector in the Chinese economy, they're taking on a lot of vested interests there. I think what's key from the third plenum document, but also some of the supplemental documents that have been released by central bank and the prime minister, they talk about swallowing the hard bones. All right? They talk about going into deep water areas. They talk about taking on the wall of vested interests. And they've also given themselves a timeline. Right? It's been a while since I think China's given itself, other than 5-year plans, where they've given, probably not since Zhurongji, where they've given themselves a kind of timeline to deliver on these things, and it's 2020. So in that sense, I think they've implanted some urgency into this process, and combined with some of the anti-corruption measures that they've been taking on, Xi Jinping, we only hear about some of it in the West when it makes it to the media. It's actually much more far-reaching going on inside China.
Nicholas Lardy, as you look at the way in which Xi Jinping has governed in his first year, if you had to say, here's what I think his vision for the next 6 years, taking us to 2020, is for China, how would you characterize it?
Well, I think it's, I think his #1 goal is to maintain economic growth and social stability that comes with that. I think he's convinced that a more market-oriented approach, more fair competition, price liberalization of the exchange rate, and all the other measures that are laid out is the way to accomplish that. However, I mean, Greg would be the expert on this, but he certainly is carving a path that he's cracking down on the political front. So it is a long-term tension between having a more and more liberalized economy to sustain economic growth and cracking down on opposition to the party on the political front.
Greg, do you see much evidence of much evidence of an attempt to not necessarily have the party control every aspect of people's lives in the way that it did in the past?
Well, I think, yeah, I think there is some withdrawing, if that's what you're asking, Steve, from kind of everyday life, right? I think the party's trying to set the agenda right now for reform and to lay out the priorities. And I think they're trying to take on some of the big vested interests, whether in the state sector or elsewhere, even and in the political apparatus as well, out in the local areas, that might not be so into some of these reforms. But at the same time, I think there is a recognition that when Xi Jinping talks about China Dream, right, there's a reason why they feel there's a need to come up with some kind of life affirmation statement. They realize that not everyone's happy inside China. There's growing gap between rich and poor. There's a growing, perhaps, feeling that not everyone gets a fair shake in China, that there are some people who get a lot more privilege than others, and that's where the party draws some negative attention. And so I think in that way, they realize they have to deal with some of these things.
Okay, let's come full circle in our last couple of minutes here. And Nicholas Lardy, I'll ask you to weigh in first on this. Give us a sense of what you believe the consequences for the global economy will be if, in fact, China's economy does slow down more than economists anticipate this year.
Well, there's no question, China has been the biggest contributor to global economic growth for quite a number of years now, even though they've slowed down to, 7.5% roughly compared to the 9 or 10% of years ago. The economy is now so large that even on that slightly slower growth rate, it's the biggest source of incremental growth in the world economy. If their economy should slow down, let's say to 4 or 5% for a sustained period of time, half of that growth would go away. And so global growth would come down. China's demand for commodities and raw materials, capital goods, and so forth would all be reduced very substantially. And that would have a very big drag on global economic growth.
Greg, your view?
Yeah, I think Nick is right. China's been one of the key growth engines coming out of the global financial crisis. It's not in anyone's interest globally for China to stumble hard. I wish the Central Bank of China well in managing financial stability through all these difficult reforms. I think there's reason to be hopeful, though, that, and this is where Nick, I think, would maybe feel similar. It'd be interesting here. Something that's hopeful about it is that I think the Chinese leaders have identified ahead of time what are the potential problems, and they're trying to take measures to deal with it before a crisis happens.
Sure. I know, relatively speaking, Canada doesn't do that much business with China, certainly not remotely compared to what it does with, for example, the United States or other countries. But if the Chinese economy were to slow down more than is anticipated, can you give us a sense about what the ramifications on this country could be?
Well, I think China's got, China's a key export market for us. Mm-hmm. And so I think in that respect, Canada would want China to continue, I think, on a stable growth trajectory. And it's not in Canada's interest for China to stumble hard. So I think what would be very interesting is there's been growing interest from China to invest in Canada. And that's the other side. So the one side of it is exports to China. Mm-hmm. The other side is two-way investment, right? And I think also now we have the stock exchange. We have a office in Beijing, and there's lots of talk now, or there's a beginning of talk in the banking sector of Canada too, about renminbi coming out of China and being invested in Canada. So I think in that respect, there is serious demand from China for some of the things we have. And so I think in that sense, if China gets hurt, it will hurt Canada too. Mm-hmm.
Nicholas Lardy at the Peterson Institute in Washington, D.C. It's good of you to join us on the line from the American Capitol. Thanks for your participation in our program tonight.
Thank you, Steve.
And Gregory Chin, good to see you again as well from York University. Thanks for coming in tonight as well.
Thank you, Steve.
Support Ontario's public television. Donate at tvo.org.